I'm delighted to welcome regular followers of our webcast, and I hope those that are viewing for the first time. This is the first conversation of 2015 with Michael Hughes, who's Fiducia's economic and investment consultant. Michael, welcome.
Thank you.
Thank you again for your time. We should first just look back at 2014 in terms of how events unfolded, what their effect was, what sort of year it was in investment terms. But then looking at 2015, we're only 3 weeks into the new year, but there seems to be plenty to talk about and consider. We've seen a continued fall in the oil price, which is obviously significant, we would expect, in terms of its effect on the global economy. The Swiss National Bank took everybody by surprise with their ending of the euro peg. Maybe even the ECB is seriously considering doing QE at long last after all this time. And of course we appear to be sort of already into the early activities of the election, and that may well have effect upon markets as well. So I'm sure that's only a few of the things that you're going to cover for us.
Good, okay. Well, perhaps if we start with 2014, because there was a positive bit and a negative bit. And if you look at the investment returns for 2014, they were pretty subdued. And even high-risk payers, risk takers, were not paid a great deal more than those who were pretty cautious. So it was a very flat year, and in contrast to the previous 2 years. And the negative aspect for 2014, which had been worrying us, was that there were likely to be some negative surprises. And the most negative surprise was that expectations for economic growth were going to change. Now, as we've gone into 2015, places like the World Bank, the IMF, forecasters generally have been taking their forecasts for growth down. So those negative surprises have in many ways now been reflected in the market. Also, we were perhaps concerned that there may be negative surprises in terms of monetary policy. In other words, the ending of QE in the States, and more importantly, the lack of any real QE, quantitative easing, for Europe. And as we've seen, there's now a real concern that Europe is going into a deflation with falling prices, which, when you have large amounts of debt, isn't the best place to be. So, to some degree, there was a negative aspect which I think markets were proving to be pretty cautious about. The positive side of 2014 was that you began to see some major reform programs in part of the big Asian economies. You saw it after the Indian elections, and the reform program that's been rolled out there looks pretty impressive. You've started to see it in Japan, and you've continued to see it in China, but we know that China is a much longer story. And indeed, if you look at the returns for sterling investors last year, the Shanghai Chinese stock market was up nearly 70%, and the Indian stock market was up by more than a third. So even though people think it was a pretty flat year generally, and particularly for emerging markets, actually within emerging markets, and particularly within the Asian part of emerging markets, there were some actually very positive returns. So there was a positive element of 2014 and obviously a negative element.
What you were saying there about those returns in China and India in particular, that's before sort of currency movements?
No, that's in sterling terms.
That's in sterling terms.
So that allows for what happened to the currency. So, but you contrast that with Russia, for example, which was down more than 40%, and Malaysia was down, and Brazil was down. So all the oil exporters or the commodity sensitive areas were badly hit. But those who were beneficiaries of that and were undertaking major reform programs, then by and large the investors did well out of those.
So not all bad news.
No. And indeed, going into 2015, I think the Asian story will continue, because by definition the reform programs there don't happen overnight. They are continuing in India, they're certainly continuing in China and Japan, and you're beginning to see them elsewhere, in Korea, in Indonesia, because by and large in a competitive environment, and these are the areas of the world that are the fastest growing, arguably will be the biggest in years to come, they need to have a private sector and a capital market that can keep pace with the size and development of their economy. So to some degree the capital markets have been lagging behind, but the reform programme is something which actually helps them to catch up. So I think it's possibly important still to have an Asian focus within the portfolios because there's a lot going on.
And no doubt, as you'll comment later, they're all net beneficiaries of the reduction in the price of oil.
They are, and we've had virtually a halving of the oil price. It looks as if it's more to do with supply than it is demand, because although there's a sensitivity about demand falling away, not least in places like China, not a lot of evidence that's happened. Whereas if you look at the supply coming out of the States with fracking, if you see what Saudi Arabia and the OPEC generally are doing, quite apart from Iraq and Libya trying to put more oil back on the market to rebuild their economies. So the supply side has been much more effective, I think. And because of that, the relatively lower oil price, I think, is going to be with us for a while. Now that is a big boost to the global economy.
I've seen some amazing numbers that have been quoted in the recent
the range of the boost to economic growth goes from 0.5% to 2%. But either way, it is a boost. And even in areas that have been suffering, not least Europe, for example, that's a very necessary boost because it comes at a time when obviously demand generally has been pretty weak, and the ability to boost living standards and to boost corporate spending is clearly very important.
When you said it's about supply, I mean, it appears to me that, what I've read generally, that it's all about market share, and the OPEC countries, in particular in the Middle East, they don't want to lose market share. So they're in this for the long term.
Exactly. I think a lot of the developments that we've seen are relatively permanent. So I think we can be reasonably confident that a large part of the fall in the oil price will be with us for some time, and hence the boost to the living standards and economic growth is obviously something that we can enjoy for this year. So that's a positive for 2015. If we look beyond 2015, and I keep making this point, but markets don't look out a matter of months, they look out almost a matter of years. The question I think we have to ask as investors is that we have built up an enormous amount of debt. In fact, part of the whole quantitative easing programme has added to that debt burden. And at some stage, we have to deal with it, because we can't live with this amount of debt. And the only way you can actually reduce debt is either by having more economic growth, or allowing more inflation to devalue that debt, or indeed defaulting on the debt. Now clearly two of those paths are negative for markets, and one is positive. So I'm going to put a positive spin at the moment and say that I think the positive development is more likely than the two negative ones. But then you have to ask the question, how do you generate growth? Because in this environment with large amounts of government debt, governments cannot spend their way out of this environment,
which they've done in the past,
or indeed borrow their way out to a marked degree. So you're reliant much more on companies, and arguably larger global companies, in order to have the incentives to grow. Now, the governments are looking at this, and they have reduced corporate taxes, but there's a bit of a competition to have the lowest corporate taxes now. Equally, you've seen technology develop, but much more importantly, you've started to see companies that many of us have never heard of certainly hit the global stage, out of India, out of China, out of Latin America to some degree, and these are the big global players of the future. So one of the investment themes that I think is important is to try and find those companies, those funds that specialise in finding companies that are the global players of the future and are the source of the economic growth that will help us deal with our debts. That is one of the big investment challenges for 2015 and indeed beyond.
Do you expect to see any defaults? Because there's been talk about what might happen with Greece.
The problem with the default is that it takes many forms. Governments can reschedule their debt, make it longer to repay, and you could argue, well, that actually is a default. And indeed, the ratings agencies would actually count it as a default. But effectively what they're doing is trying to put off the day of reckoning. So a little bit of wriggle room, if you like, to that. But yes, I think there will have to be a fair degree of rescheduling, and a degree to which the larger players, not least in Europe, I'm thinking of Germany, will basically have to say, no, we're prepared actually to forego some of the debts in our neighbouring countries, because they're never realistically going to get out of this hole if we don't actually reduce their debt burden. So I think there'll be an element of debt forgiveness as well.
So because of that, then what's being talked about semi-informally at the moment about QE actually happening in Europe? I mean, do you think do you see that happening now?
I think it's inevitable that you will now get, given that the European Court of Justice has given the approval for the sort of bailout that was being proposed a little while ago, which hasn't yet happened. Now that they've effectively given a formal approval to that, then I think the ECB will provide some support. However, the ECB always does it with conditions. It's never as straightforward and as open-ended as you've seen in Japan or indeed the States and the UK. So the conditions attached to it may still be part of the ECB's need to be able to ensure that they're abiding by their original constitution. So I don't think it's going to be as full-blooded. Much more importantly, I'm not sure it's going to work as well as it has elsewhere, because most of the funding for the small and medium-sized companies in Europe actually comes from the banks. It doesn't come from the capital markets. Very different in the States. So the quantitative easing in the States provided a boost to capital markets. It provided, therefore, a boost to the corporate sector in the States. The mechanisms in Europe are very different, and hence I'm not so convinced it will be quite as effective. But time will tell, and either way, we have seen a very big support programme coming out of Japan, and to some degree, US and the UK are in no rush to unwind the support that they've given.
And in terms of the election in the UK,
well,
obviously it's going to be a close run thing, so that markets, as we know, don't like uncertainty. But in terms of how they look forward on this, I mean, what's your take on?
I think it's pretty unpredictable. You know, you've got so many different permutations and coalitions, and I think it's impossible to judge the voting habits of the UK electorate in this environment.
Does it matter in economic terms?
I think it does matter. It matters for several reasons. Firstly, because you want some degree of certainty about policy making. And the idea of having another coalition where you have not weak government, but you have diluted policies, when you really need another term to get rid of the debt or to reduce the debt, that I don't think will go down well in markets. Plus the other thing which I think needs to be borne in mind is that although you have seen currencies come down dramatically, the yen has come down, obviously you've seen the euro come down, actually sterling hasn't come down a great deal. And although people can think of it being in the 170s against the dollar a little while ago, and it's now in the 150s, actually sterling isn't cheap. To really be cheap, you're looking at something that has to be in the 130s to 140s. So my fear is that if you have greater policy uncertainty because of the election, that it will be sterling that suffers. And hence that UK bonds particularly, relative to overseas bonds, won't look as attractive, and hence you will see that it is part of the UK markets which have in the course of 2014 started to underperform. I fear that may actually continue into 2015, but much more so, I'm more concerned about what may happen to the currency.
So when you roll all of this into the decisions that we make in terms of the portfolios that we're running for clients, how should we see that influencing the decisions those decisions that we make during the year?
To some degree, we have already prepared for this scenario. Our holdings in overseas bonds are higher than those in UK bonds, and some not portfolios we don't have UK bonds at all. Where we do, we prefer the index linked to the conventional bonds, so we've got a defensive strategy for the UK in place. We are looking for exciting new funds to play the new global players, and some of those have been found, and I hope that we'll find a few more of those over time. and the Asian play that we've built into portfolios, I'm pretty comfortable keeping in 2015. And the only difference, I guess, is that whereas last year we were relatively defensive, we were concerned about negative surprises, I'm more minded to think there may be one or two positive surprises in 2015, possibly away from the UK rather than in the UK, and I hope that we can reflect that in our portfolios this year.
Well, Michael, thank you ever so much. Thank you for joining us, and we look forward to seeing you again the next time we meet Michael. Thank you.